In this video, I'm going to present 10 growth and dividend growth stocks with extremely low debt and, most importantly, very consistent operating histories over time. But best of all, they're in value today. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, a.k.a. Mr. Valuation. I've done a lot of videos here where I've shown some what I would call really deep value stocks. Some of them had decent records, some of them didn't, and so on. And I do want to make sure that people understand what I ideally like. Now, one of the problems I feel like I'm facing as a value investor is an extremely high stock market and an aberrantly long-running bull market. This is one of the longest in recorded history. And ultimately, all bull markets end with a bear market. And of course, all bear markets end with a bull market. The really good news is bear markets tend to be short-lived, while bull markets tend to live a lot longer. But this one's pushed that even to the extreme. So one of the things I'm looking for is value and consistent growth. So I've got 10 stocks in a portfolio here. In today's higher interest rate environment, hopefully Fed might be cutting rates here coming, but they're still pretty reticent to do that, as they just recently announced. But I've got 10 stocks here with low debt to relatively low debt and good growth and very consistent long-term patterns. So let's go into FastGraphs here and look at some examples. This is the portfolio of 10 stocks that I'm looking at. And what I want you to note here is they're all investment grade with BBB or above credit ratings. They all have moderately low debt. Some of them are pushing the limit at 40% and higher. We have Ameriprise at 50% debt, but that's, I think, a misnomer. They really don't have as much debt as it appears. But a lot of these companies have very low debt. And again, they have very high credit ratings. They've got good long-term estimated growth. But one of the things I really like about these companies are they're very consistent. So let's start by looking at Elevance here. Elevance is a managed healthcare company. And what I like as an investor is I like to see, this is what I consider to be a quintessential company that I look for. Earnings growth has consistently grown year after year after year. You can also see that they initiated a dividend in 2011. And the beauty of FastGraphs is you can see the payout ratio was very low here, but over time the payout ratio has increased over time to where now they're currently up to about 18%. But they've also seen some accelerated growth here in recent years. Now, the beauty of FastGraphs as a research tool is it helps you decide when it's a good time or a bad time or an optimum time to be buying the stock. And a company like Elevance actually works perfectly from the standpoint of what I like. If I put weekly closing stock prices on the graph, this black line, you'll see that the stock price has tracked the earnings growth very, very consistently over time. Not only has the earnings been growing very consistently, the stock price has consistently tracked that. And also you can clearly see on this graph that the best time to be buying this is when the price-earnings ratios got very low, like during the recession of 08 and 09 here. And they stayed low for some time, but then they began to revert to the mean. Then we saw modest periods where the PE ratios got moderately high, but not massively overvalued. The stock's never been terribly overvalued. It has been significantly undervalued at times. Currently, it's trading at fair value, and it's coming off of being overvalued in 22 and 23. So when I look at this stock, one of the things I want to do is see how the performance is. Now, I'm looking at a time frame here where it started out in value at a PE ratio of 15, which is the orange line, and it's ended now at a PE ratio of 15.16, or approximately 15. So this company's had a 13.34% growth rate. If I go into performance here and scroll down to performance, I see that we have a historical annualized rate of return, or rate of return based on pure growth, no dividend here, of 13.74%. That's very, very consistent with the earnings growth achievement. And it's far superior to the S&P, I want you to notice. They also paid total dividends superior to the S&P. All right, and I think that's critically important. Now, I like to look at them in order of oldest first. I'm looking at it newest first here. So the reason I like to do that is I want you to see that the dividend growth has actually held up and recently has still been double digit over the last several years. So I like that. Now, performance here is against the S&P 500. I want to make another point. They outperformed the S&P over this time frame because number one is, as you can see by the blue line, their earnings growth grew by 1,226% versus 314% total growth from the Standard & Poor's. So they grew much faster. The blue line represents the growth. This second chart is a valuation comparison, and what I also want you to note is now the S&P started out at a valuation disadvantage, but they have a valuation advantage now. In other words, the orange line or the S&P is well above, with a PE of 24, above its earnings line, where Elevance is trading at a PE of 15.16, which is basically in line or just slightly above the fair value of 15. So we're dealing with fair valuation to fair valuation versus high valuation to extremely high valuation. We can see that the valuation here, the PE was 21, it's actually higher now at 24. So the point is, like I always say, measuring performance without simultaneously measuring valuation is a job half done. But I also showed here that performance is a function of growth. When stocks are trading at value, you get to fully participate in the growth of the company. So looking at Elevance here, what do I like? I like the fact that it's been consistently producing earnings results. I like the fact that it only initiated a dividend in 2011, yet because of the growth of the dividend, it's actually produced more income than the S&P. It only has a 1.23% current yield, which is below the market yield, but on the other hand, it's growing at a very, very high rate. And so this has been a really good performance. Looking at forecasting going forward, analysts expect this company to continue to grow at 12.2%. And I want you to notice they have an impeccable earnings estimate or analyst scorecard. Analysts have been right virtually 100% of the time. They beat it 17% of the time on a 1 year and hit it 83% of the time, and likewise on the 2 year forward. So this company's got a very consistent history. The company obviously gives good guidance to analysts, and analysts have been spot on in forecasting the growth of this company. From a standpoint of looking forward, assuming it does grow at these rates, and there are 20 analysts and 21 analysts that are forecasting that, and the analysts have been very consistent. Actually, the earnings growth has increased ever so slightly over the last 3 and 6 months period of time. So we're looking at a stock here that has a potential to offer a 12.89% annualized rate of return, which is pretty consistent with its historical. If you were using a normal multiple of 16, which is slightly higher, then you would see as high as a 15.7. And that's what this is. This is a discounted cash flow analysis here. This is forecasting the future, in this case, operating earnings. And then we're using a discount rate of the growth of the stock, so which is producing the growth of the income here. And then we're simply saying if it grew this money at this rate, or in this case grew earnings at this rate at these levels, and then traded at that normal multiple, that'd be your rate of return. So it looks very attractive at today's level. Now let me go through a couple others here real quick. The next one on the list is Ameriprise, which is a spinoff from American Express. Now the market, because it is a financial, has given it a discounted valuation of 12.18, but that still would give almost a 10% rate of return. If it traded at a more realistic or rational PE of 15, you'd be able to earn almost 19%. So you're looking between 9 and 19% potential rate of return here. Looking at the history of this company, if I take price off of the graph, it's also been very consistent. Now, during the financial debacle, it did have a significant drop in earnings in 2008 from $4.03 to a negative 20 cents, but then it recovered very quickly. And if we look at this recovery period here, we see that the growth has averaged almost 16.7%. And if I put price on there, you can see that the price has tracked that, albeit at a slightly discounted valuation because of the negativity of financials, if you will. But looking forward on this stock, the forecasting graph, where analysts are still expecting over 12% growth, 12.66% going forward. If the market valued that at a 15 PE, that would be an 18% rate of return. If we use this normal multiple, where for the last 5 years, and that's your drop down here, is this is the normal multiple for the last 5 years, has been in the 12 range instead of 15. We're still looking at an opportunity here to make just under 10%. And that would be because technically it's trading at a 13.4 multiple above the 12.18, but it's also trading at a discount to what would be the theoretical fair value for a company growing at 12% a year. But I like Ameriprise, again, for the consistent growth over the long period of time here at double-digit rates. The next stock now on the list is going to be Cigna, and Cigna is another healthcare services. It's A- rated with 42% debt, 1.76% dividend yield, and a 7.92% earnings yield. But once again, without looking at price, just looking at the business itself, I love the fact that it's been such a consistent grower. It had one little blip here in 2016, but it followed that for 3 years in a row with very strong earnings growth. Company started paying a dividend. It was paying a real modest dividend for all these years, but started increasing the payout ratio to almost 20% in 2021. So if I put price on the graph here, you can see that it's tracked that, but it's tracked it at a discounted PE of about 12, just like we saw before. It's currently trading at a PE of 12.6, so it's in line. From a standpoint of forecasting, it's expected to grow at double-digit rates going forward. Again, it has an almost perfect analyst scorecard. I like companies where the analysts are able to get it right most of the time, and Cigna has been another example of a company that they've been able to do that. It's an extremely consistent grower, and you can see periods of high valuation which were less optimal times to buy, but you can also see periods of low valuation. It's currently trading at a very fair valuation, offering a good long-term opportunity if you're a long-term investor. The next is Amdocs. This is IT consulting. Now, what I want you to notice here is that it was overvalued significantly, or for most of the time prior to the Great Recession. Then once the Great Recession came in, it actually got very inexpensive. And that would have been a great time to buy the stock, obviously. Even at today's low valuation, where it's trading below the orange line, you'd have made double-digit rates of return. That's one of the real aspects about growth. If you pay attention to value and you get good growth from the business you're investing in, even during periods when the market is undervaluing the stock, you can still do well. And of course, if you're looking at periods where the market was say, slightly overvaluing the stock, your rate of return would shoot up to almost 12.8%, which is very, very attractive. Now, looking at this from a standpoint of fair value to undervalue, the performance relative to the S&P 500 has been meaning they've not performed as well as the S&P. They've averaged almost 9% versus the S&P 1287. But a point again is the S&P is significantly overvalued, and we're looking at Amdocs actually being undervalued now. So in other words, we're comparing it at a big disadvantage to the market, and yet we're still generating a positive rate of return, and I would argue taking a great deal less risk. And once again, what I like here is the consistency of the company's operating history, and that's even through the recession. It flattened a little bit, but it still was very profitable during the Great Recession, and it was even had modest growth during the COVID era. So there you got Amdocs. The next one is Elevance, which I've already covered. Then we're going to look at Global Life. This is a very interesting situation. The stock is A-rated, only has 22% debt, has a modest dividend yield, but an earnings yield of almost 14%. Now you can see the dividend white line here has been very consistent. They've grown the dividend consistently over time at a pretty decent rate. We'll look at that in a moment. But they still don't pay out very much. They only pay out 10 or 12% of their earnings. That's the area below the white line here. But when you put stock price on the graph, weekly stock prices, something very interesting shows up. Now you can see that the stock, because again, it was in the financial sector, a life and health insurer, but related to finance, it went through the recession with pretty strong numbers considering most stocks. The market did drop the value down. What a marvelous time to buy it. And you can see that it tracked earnings beautifully over time, giving you opportunities to buy it at attractive valuations and giving you the foresight to avoid it at high valuation. But then we had this big over almost 50% drop in value because the company did have a lawsuit or a pending lawsuit, and the SEC is currently investigating them. But if you go into Morningstar, for example, and look at Morningstar, Morningstar gives it a fair value of $145.61, and it's currently trading at 80. So that is an indication of how undervalued it actually is. But there are these lawsuits that were filed by, I can't remember the company's name, Panda something or other, and they accused the company of securities fraud and their investors. Now, if you go into the corporate website of Global Life and go into the investor services, go into About here, and then go into investor services, and then look at news releases, you'll come up across, I'm not going to bore you with, but that's how you would do that, where the company came out and really denied all the allegations. But there is an SEC investigation, and of course that creates a tremendous opportunity in the stock. You can see that it has rallied relatively strongly. I guess it got down here to in the 60s, and it's rallied now back up into 81. So we've had a pretty strong rally off of the direct bottom here. But I would do your due diligence. The growth of the company is expected to continue to be strong, right at 12% a year. The normal multiple of the stock has been about 13. This would give us really tremendous rates of return. The analyst scorecard, once again, is almost impeccable because it had been such a consistent performer. But there is this lawsuit. This could be a great opportunity, or it could be a real big danger to the stock, and I'm going to let you decide that for yourself. The next company on the list that we want to go to is Genuine Parts. Now, what I like about this stock is it's BBB rated, has 43% debt, but Genuine Parts is a distributor of parts. And again, one of the things I like with FastGraph, you can go directly into the company's website. You can look at what the company does, and I think many of you have probably already seen their truck and their Napa products and so on. So Genuine Parts is a very high-quality, established company. Notice that the market has had a penchant to valuing it at a very high valuation, around 18 times earnings over this time frame. Even if I drop that time frame, we'll see that the market has priced it at a very high multiple. Normally speaking, during the COVID, it got down to a very low multiple here, something almost single digit, 11 times earnings. It's currently trading at just under 15 times earnings, has a strong earnings yield, and this is I would say, a very attractive entry point for this company, who's forecast to continue to grow at around 8% a year and give us a double-digit rate of return going forward. And once again, the company has a very solid analyst scorecard, so the analysts have got this company right most of the time. So I think it's a unique opportunity to invest in Genuine Parts at a valuation that makes sense. Now, during the recession of '08, you could have bought it at around 15 times earnings. And any time you bought it here, these would have been really good times to buy the stock where you could have generated double-digit rates of return. I think you've got that opportunity right now in Genuine Parts. The next stock we're going to look at is Global Payments. Now, Global Payments just made a major acquisition in, I think it was 2019, where they bought Total Systems, and the stock has been negatively down. Once again, if I go to Morningstar, just to get another opinion for you and look at Morningstar, they give it a 5-star rating. They give it a fair value of 180, and it's trading at 95 or 96. So it's really trading at a 5-star price as far as Morningstar is concerned. And this was kind of an enigma to me. I am long this stock. Looking at it going forward, the expected growth is over double-digit, 12% growth. That would create at a 15 multiple, that would give us a 40% annualized rate of return. If I look at the normal multiple, which has been higher, as we're looking at a 55%. And if you review that by looking at FastGraph, this is how I say it's an analytical tool. We can see that it's traded going all the way back here into 2003. It was trading right in line at a 14 or 15 multiple. Then we had this period starting in 2016, as we did with a lot of companies, where we had these extended multiples into the 20s times earnings, and it peaked out here in April at 30 times earnings, and then we had this correction, and now we see the stock's struggling. Now, it's been paying a dividend for a long period of time, but really with almost no payout ratio. It's only paying a modest dividend, but it's the growth of this company that's attractive, expected to be double-digit going forward. And again, it's BBB company with only 38.5% debt to capital. So I think the stock with an earnings yield over 11% is a very attractive opportunity that I would suggest you take a closer and stronger look at. The next one is Ingredion. This one's a little different. I do like the fact that I used it because it does have very low debt. It's not quite as consistent It's an agricultural products and services, and it sells a lot of, if you go into their corporate website, you can learn a little more. If you look at their categories, they're anatomy, nutrition, beauty, beverages, paper and collagen, bakery, dairy, confectionery. The ingredients are things like allulose, which is a sugar substitute, and of course fibers, flours, gums, plant proteins, a lot of the additives that go into our food supply. I'm not sure that I really like that, but the company has been very successful. They've averaged double-digit growth. They do have a moderate amount of cyclicality. Looking at forecasting, analysts are expecting over a 7% growth. One of the weaker scorecards of all I looked at, but the opportunity here does look very intriguing at almost a 20% annualized rate of return, and one of the higher yielding stocks in the group at 2.71%. And again, their scorecard is not as, it's good. They beat 17%, they hit 50%, and they only missed a third of the time on the one-year forecast. They only missed 17% of the time on a two-year forecast. So I like this stock as one that I think you should put in your research process here, because I do consider it trading at a very attractive valuation here, given the fact that it's got some decent growth potential going forward. And again, I want to remind you the dynamic nature of fast graphs. Always put these stocks through these different time iterations. It's just as simple as I'm doing it here by just clicking the button. But anyway, that's Ingredion. The next stock on the list is Raymond James Financial, and this is an investment banking and brokerage company. It's A-rated, has 24, just under 25% debt, and this has one of the most correlated price and earnings charts you'll ever look at, and you can clearly see when the stock gets inexpensive that those are great entry points, and the stock is trading below the orange line now. It's maybe not as attractive as it was in April of 2023, but I still consider it very, very attractive. I look at forecasting here. It's got an 8 or 9% forecast. It's got 15 analysts. Analyst estimates have actually been increasing, and it's got a really good scorecard. Not as good as some of the ones I showed, but a very solid scorecard. They've only missed 17% of the time on the 1 year and only 8% of the time on the 2 year, with obviously some periods of margins of error in there. Next, we have Snap-on, and Snap-on, we only get estimates on Snap-on out about it for this year and next year, but this company's grown at 13% a year. The forecast is only about 5%, but it's trading at a 14 multiple. That would still give us a double-digit rate of return going forward with almost a 3% dividend yield. Again, one of the higher. It's got an impeccable analyst scorecard, so you can put a reasonable amount of credence or faith in Snap-on going forward. So as far as analyst estimates, it's a very consistent grower. It kind of had an earnings weakness during the recession, had an earnings weakness during COVID, which is this gray line, but otherwise we've got very consistent growth going forward on this stock. So I find it to be another one that's very, very attractive. So all in all, what we're looking at here are 10 stocks that are investment grade credit ratings. They are 10 stocks with moderate to low debt. They are 10 stocks with good growth potential, and they are 10 stocks that have been consistent performers over time. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. I hope you can see how useful this tool is. It can really help you identify companies like the 10 that I've shown here in this video that are attractively valued with very consistent records and very high quality credit ratings and very low levels of debt and very consistent operating histories. And they all look attractively valued at today's level. So I, as always, suggest you do your own research and due diligence. Thanks for watching. If you like the video, give me a like. If you haven't subscribed to the YouTube channel, please do. And for goodness sake, take a look at the FastGraph Fundamental Analyzer software tool and try the free trial at least, because what a great way to be able to guide you in your investing going forward. Not only is it reasonably priced, but I think it's worth every penny. Thanks for watching. We'll talk to you again real soon.